Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us is Ryan Detrick, Chief Market Strategist over at LPL Financial. Ryan, it's great to see you as always. Welcome back to Trade Talks.
Jill, thanks for having me back. Appreciate it.
You got it. And a note from October 6th, you had said volatility is the price of admission. What do you mean by that?
Yeah, Jill, it turns out stocks can actually go down also, right? After a 104% rally, a 7-month rally, a 6-quarter win streak, we saw finally the first 5% correction in nearly a year, at least in the S&P 500. But if you look under the surface, there's a lot of Nasdaq stocks that have actually pulled back more than 20%. A lot of S&P 500 stocks pulled back more than 15%. But again, a lot of investors have just gotten in this market, recently, and they think it only goes up. I guess the key concept, stocks can go down also, and that's the price of admission to reach long-term investment goals, in our opinion, at LPL Research.
And despite the recent bout of volatility, 2021 performed quite well so far in aggregate for the first 3 quarters. We know October is historically volatile, and there are a number of macro outliers, including supply chain constraints. What are your thoughts for Q4?
Yeah, 2021 is off to a great start, right? As of the end of the third quarter, up about 15% for the year. You look at the fourth quarter, as most of us know, the fourth quarter is the strongest quarter out of all 4 of them. October gets a bad rap, I think. It's really just more volatile than anything. No bigger moves than the month of October if you look at all 12 months. But what does it all mean? Well, if you look back in history, Jill, the last 10 times, this goes back to like the late 80s, the S&P 500 was up at least 12.5%. So it's a good year heading into the normally bullish fourth quarter. That fourth quarter is actually higher 9 out of 10 times with some really good outperformance. So that's just one data piece, but seasonality is strong, all the government stuff, and I think maybe we're going to get into that soon enough. There's some other things going on that say, hey, this is still a bull market. The fourth quarter still looks like we could see some pretty good moves in stocks higher here.
And Ryan, while a lot can happen between now and the end of 2021, the market's always worried about something. Is it too early to start thinking about what stocks might do next year?
We'd say no, right? We just produced a piece that took a look. We think, earnings this year, 2021, likely going to be up over 40%. So maybe we're taking some of that earnings growth this year and stealing from next year. We still think earnings growth next year can grow maybe, high single digits potentially if everything goes well. And that's still a really good growth. And the key concept, Jill, we're trying to tell our more than 19,000 advisors is this. This is mid-cycle, right? Early cycle stuff may be slowing down, but it's not end of cycle. There still could be several more years of economic growth coming with all the fiscal policy, monetary policy, all the stuff we've all talked about that are tailwinds with an economy that continues to open up and strengthen. Look, as you and I speak, copper is breaking out. And what does that mean? Dr. Copper, if copper is strong, the global economy is usually strong. So I know last week's jobs numbers are weak. There are some underlying factors that are saying things are still pretty good on the economic front as we head into 2022, which should lead to a continuation of this bull market.
And back to earnings, beyond those widely reported supply chain challenges facing corporate America, what other reasons could be attributed to why results this quarter could be closer to expectations?
Yeah, overall expectations right now for the third quarter are about 28%. Maybe we can round it up. Let's just say 30% year over year. Remember, last quarter was 90%. The quarter before that was like at 50%. So we've seen huge beats the last couple of quarters. So maybe just get back to trend and beat the estimates by about 6 or 7%. You go back since 2009, only once did earnings come in less than expectations. So it's widely assumed we'll probably beat the 28%, maybe mid 30%. But I think it's just kind of all about those expectations we talked about coming back to life. But to put a bow on it, what have we heard from companies already, right? Higher prices, the supply issues, whether it be on materials or workers, those things potentially could hold earnings back a tad as well versus those huge beats we saw the previous 2 quarters.
All right, Ryan, we appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.